How to start investing in your 20s. What if I told you that the money you earn in your 20s could be worth 10 times more in the future, without you working any harder? That's the power of investing. Most people wait until their 30s or 40s to even think about it. However, your 20s are actually the most powerful time to start. Why? Because of compound interest. Time is your greatest weapon. Even small amounts, like $50 or $100 a month, will snowball into hundreds of thousands of dollars over decades. The earlier you begin, the easier your financial future becomes. For example, if 44 years ago, a 21-year-old invested $100 every month with a 10% annual return, they would now have about $1 million. Before we get too deep into the video, I need to remind you that I am not a financial advisor. This content is for educational purposes only. It should not be taken as professional financial advice. Always do your own research or consult with a licensed financial advisor before making investment decisions. What investing really is. So let's clear up the biggest question. What is investing? Basically, investing is the process of putting your money into assets. They may include things like stocks, bonds, or real estate. The goal is to grow it over time. Think of it as planting seeds that with time can turn into trees. Here's where people get confused. Saving and investing aren't the same. Saving means putting money aside in a safe place like a bank account. It's secure, but it doesn't really grow. Investing means letting your money work for you. Yes, it carries some risk, but the reward is growth that saving alone can't achieve. Building the foundation first. Before you jump in, you need a financial foundation. Think of it as building a house. You can't put up walls without a solid base. Step 1 is to create an emergency fund. Aim for at least 3 months of living expenses. That way, if life throws you a curveball, you don't need to sell your investments early. Step 2 is to pay off high-interest debt. If you're carrying credit card debt at 20% interest, no investment will outpace that. Clear it first. Step 3 is to build a simple budget. Track your income and expenses and identify how much you can set aside each month for investing. Even if it's small, consistency matters more than size. Beginner-friendly options. Now let's talk about where to actually put your money. The first option is individual stocks. Buying a stock means owning a piece of a company. If the company grows, your investment grows. The downside? Stocks are risky if you only buy a few. That's where index funds and ETFs come in. Think of them as baskets filled with many different stocks. Instead of betting on one company, you're spreading your money across hundreds. This reduces risk and gives you steady, long-term growth. For beginners, index funds and ETFs are some of the best choices. And then there are robo-advisors. These are apps or platforms that build a diversified portfolio for you automatically. You just deposit money and they do the heavy lifting. Perfect if you don't want to research every detail yourself. A quick analogy: buying one stock is like picking one apple at the store. Buying an index fund is like buying a basket with hundreds of apples. If one goes bad, the rest are still fine. How to start with small amounts. Here's the best part. You don't need thousands of dollars to begin. Thanks to fractional shares, many platforms let you start with as little as $5 or $10. That means you can own a piece of big companies like Apple, Amazon, or Tesla without needing the full stock price. Let's say you invest $50 every month starting at age 21. If your investments grow at an average of 8% per year, by the time you're 60, you'll have over $100,000. And that's just from $50 a month. If you can do $200 a month, the number climbs into the millions. The key isn't timing the market, it's time in the market. Starting small and staying consistent beats waiting for the perfect moment. Long-term mindset. Here's something most beginners overlook. Investing is a marathon, not a sprint. The market will go up and down. Some years you'll see growth. Other years, you might see losses. But over the long run, the trend is upward. Your job is to stay consistent and avoid panicking when the market dips. Remember, you don't lose money unless you sell at a loss. Patience is what turns small, steady contributions into massive growth. And don't forget compound interest, the magic of earning returns on your returns. The earlier you start, the more powerful it becomes. Action steps. So here's how to start investing in your 20s. Step 1 is to build your foundation. Emergency fund. Pay off high-interest debt and budget. Step 2 is to pick beginner-friendly options like index funds, ETFs, or robo-advisors. And Step 3 is to start small, stay consistent, and focus on the long term. You don't need to be wealthy, and you don't need to know everything. You just need to begin. The best time to start investing was yesterday. The second best time is today. Who should not invest? Yet. Investing sounds exciting, but here's the truth. It's not for everyone right now. If you're expecting a quick win, chasing get-rich-quick promises, or thinking you'll double your money overnight, investing will disappoint you. The market isn't a lottery ticket. It rewards patience, not impatience. When I say a quick win, I'm talking about people who jump into investing expecting instant rewards. For example, those of us who like doubling our money in a month. Or worse, those of us turning a small deposit into a fortune overnight. That mindset is closer to gambling than investing. The sad thing is that it usually leads to frustration, losses, and quitting too soon. Another famous downfall is the get-rich-quick mindset. This mindset treats investing like gambling, chasing fast profits without patience or research. It ignores long-term growth, undervalues compounding, and risks significant losses. Sustainable wealth builds gradually through discipline, diversification, and consistent contributions, not impulsive moves. Quick schemes often end in regret rather than financial security. And if seeing your balance drop by a few dollars gives you anxiety, you may want to work on your money mindset first. Investing comes with ups and downs, and panic selling is the fastest way to lose. Basically, if you want guaranteed results tomorrow, investing isn't the tool. This is because investing is, by nature, playing the long game. If you found this video helpful, hit that like button and subscribe. This channel is all about teaching you how to manage, grow, and build your money for financial freedom.